Welcome to the Well Off Podcast, where the goal is to motivate, inspire, and share success principles. I'm your host, George Masri. On this episode, I interviewed Michael Zanzini, who is the lead mortgage agent at BM Select, and he's been working primarily with investors for about 8 years now. He manages portfolio structuring and strategic sessions for investors. And on this episode, we talked about the recent rate announcement and the impact that he's seeing on the market. 40-year amortizations, will banks be allowing it in the near future? We talked about strategies to lower your monthly mortgage payments if you've noticed that your cash flow is a little bit tight. Special mortgage programs, so net worth programs, and then self-employment programs for certain individuals and who might be able to benefit from these. And then the benefits of working with TD and the recent changes with Scotiabank financing when it comes to HoldCOs. So I hope you guys will enjoy the episode. I just want to say that I'm grateful for your support and for you guys tuning in all the time to the Well Off Podcast. If you do appreciate this, make sure to share this with a friend or family member, and then leave us a 5-star review on the Apple Podcast platform. That would be greatly appreciated. If you want to connect with me to discuss investment options and strategies, I'm happy to do so. You can book a 15-minute call. I'm happy to help you guys out and share with you what I know. So just go to welloff.ca and you can book a call there. There you go. Enjoy the episode. I'm here with Michael. It's the first time we meet. It turns out we have we know a lot of the same people. Thank you for coming by today from Bolton.
Thank you. It's a privilege. Thank you for having me, George.
Yeah. So I like to just start off by asking you about your childhood. So tell me a bit about where you grew up, a couple things you remember.
Was born in North York, lived there my early years. My parents bought a house here in Woodbridge. Moved here when I was about 7 years old. So did all my elementary, all my high school years here in Woodbridge. Grew up here, born and raised. Italian community, hence the last name, obviously, right? The stereotype. But yes, full circle. Yep. Stereotype is real. All the Italians are here pretty much.
Yeah.
Grew up here in Woodbridge. Pretty great childhood. Sports. Come from a great family, immigrants from Italy. Mm-hmm. Instilled a lot of life, good lessons in me, which stick with me today. Smart with my money, investing, being honest, transparent.
Pay off your mortgage.
Be respectful, and just live every day. Try to take the best of every single day, right? Every day above ground is a good day.
Yeah. So I don't know if you probably don't know this, but I'm married to an Italian.
Oh, fantastic. Good for you.
Thanks. Now every time like you meet an Italian, they always ask, where are you from? Like, which part of Italy? So I'm going to ask you, which part of Italy is your family?
Both my parents are from Rome, small town Frosinone. Okay. So right central Italy.
Cool. All right. Seems like this is every Canadian Italian story. Well, anyone from Ontario. Start off in North York, move to Woodbridge, and then move out from there. So yeah, you got that typical story going. So let's talk a little bit about how you got into mortgages. I know Italians are generally a little more conservative, right? Like you have your job, you get paid, pay off your mortgage, and that's it. Like nobody seems to take massive risks in the Italian community, but tell me a bit about how you got into mortgages.
So how do I really want to explain this? So like I said before, I come from very good parents who instilled those traits, investing, being smart with your money and stuff like that. So my parents were investors. So in my early 20s, little funny story here, obviously me, if anyone knows, I'm a mortgage agent with BM Select. So funny story is my parents were real estate investors getting their first property, and I went with them to go meet the owner of my brokerage that I work for now to go and get pre-approved for their first rental property. And went in with them, sat down with them, got pre-approved by the owner of my brokerage. And straight from there, bought their first property, was always interested in basically money, right? Like, how do you continue to grow, purchase real estate? My parents got me involved in private lending at a very young age. And flash forward, a couple years go by, and still trying to figure out my life, what I want to do being a young guy. And called up the owner of my brokerage, and I said, hey, do you remember me? My parents are clients of yours. They're like, yeah, I remember. Came into the office. It was like in the new year. And he's like, what do you want to do? When do you want to start? He's like, I can tell that like you're trying to make a change in your life. Mm-hmm. And I've literally been there ever since, learning the ropes through mortgaging, underwriting, working with clients day in and day out, which I'm proud to say now is the lead mortgage agent at my brokerage at BM Select. So trying to summarize the story, obviously there's a lot more details, but that's kind of how I got really into investing, purchasing real estate myself. But it was because of the exposure, because of my parents, with still to this day I'm so grateful for, because where I'm at today is because of them.
Yeah, awesome. You said they got you involved in private financing. Was that so you were doing, you were lending money at that age?
Correct.
At a young age?
Young age, I'd say I was starting in my early 20s. My parents were involved in private lending, so I was working like part-time jobs at that time, saving up. My parents got me involved, whether it was $5,000, $10,000, $20,000, just accumulating the pool of money, obviously with my parents, making a little bit more, getting exposed to it and understanding it. And then purchasing my first rental property at the age of 27, purchased another one a year after that, got married at 29, recently just had a baby boy, 3.5 months old.
Oh, nice. Congrats.
So right now sitting at 4 rental properties at the present moment, all single family homes. One of them probably has the capabilities of a duplex conversion. That's something that maybe is in the works. Considering maybe dabbling now into a multi-unit, maybe a duplex or a triplex that's on the horizon. Just very time consuming doing mortgages day in and day out, likely 6-7 days a week, plus now the new addition to the family. But that's on the horizon right now. And,
how old are you, by the way?
33.
Okay. Yeah. So we're pretty much the same age. I'm 32.
Nice.
So 3.5-month-old.
Yeah, 3.5.
That's it's a big change, eh?
Change.
Big change.
Beautiful change, though. It's changed my life for the better, 100%. But yes, now I can honestly say, usually when you talk to people that have kids, they're like, wait till you have them, you'll see. Mm-hmm. Now I know what it means. It's beautiful, crazy, life-altering, but I wouldn't have it any other way.
Yeah, so you're finding it okay to manage, being at home, being a new dad and running the business and all that?
Absolutely. I'm very fortunate. Obviously, my wife carries the bulk of the weight, obviously. But it's awesome. Challenging, of course, because you always want to spend a little bit of time with him and see him as he grows up because they grow up so quick. But my focus right now, if I haven't been motivated before, it's even more motivated to continue to prosper in investing, growing the business, trying to do as many deals as I can in the mortgage space, continue to grow and make money because now I got a little one that I got to worry about.
Yeah,
right?
For sure. So I have a son as well. He's just over a year old, and when we first had him, people kept asking me like, "Do you feel more motivated?" And I don't know why I didn't feel like I became more motivated after my son was born for whatever reason. I feel like I was always motivated, but yeah, I do understand that you kind of have that extra push. Like I want to make sure he's taken care of, right?
I agree 100%. Yeah. It's exactly like I'm already a driven, motivated person prior to the child. It's just, it amplified it that little bit more now. It's like, all right.
Yeah, for sure. So where are your rentals? Are they all kind of in the same area or do you have them all over the place?
So 2 of them are in the Kitchener-Waterloo area and one is in Stony Creek on the Hamilton Mountain and the other one is in the Thorold Welland area.
Okay.
So 2 existing that we bought, existing properties, resale, and then the 2 were new constructions.
Cool. That's awesome. And then what's your goal with your investments, just out of curiosity? What are you trying to achieve?
It was so funny on the drive here too, because I'm like, I guarantee he's going to ask me about that, like strategies like going forward. And I was actually thinking about it last night on the way here. So like I said, obviously my goal is to acquire more real estate, pay them down, cash flow, continue to grow and build. But I was kind of thinking maybe a different strategy. Of course I want to acquire more real estate, but maybe the mentality is focusing on pay down the mortgage, get them paid off quicker, build that cash flow up. I'm actually going through a process right now of refinancing one of them to access the equity, to just have that vehicle in place if an opportunity comes up. Might be strongly searching in the new year in 2023. But yeah, that's kind of my strategy right now. Kind of focus on the pay down, build up that cash flow, build up that equity, and kind of take it from there, see where things go. I know the market's crazy right now. Interest rates have been on this upwards trajectory. Doesn't seem like there's no stopping. But hey, at the end of the day, we're seeing still great opportunities in the place right now, regardless of the interest rate. Some people have the saying, like, you're not marrying that interest rate. You're locking in that mortgage and that purchase price, right? The rates won't always be like this forever. Mm-hmm. If the numbers make sense, there is no emotional attachment to real estate.
So
right?
let's talk about that a little bit, because right now it's December 8th, and there was an announcement yesterday.
Yep.
So 50 basis points, another increase. What kind of reception have you had? What are you seeing? Are people afraid now? Like more afraid? Are people just at this point saying whatever? They've already increased it so much. Who cares? Like what are you seeing?
It's tough to answer that question because you see it from both sides. When you're dealing with clients each and every day, you have the people that are panicking, freaking out. What the hell do I do? Their mortgage payments are increasing, or people that are wanting to get into the market are now even getting pushed out further just because of the rising rates. I don't have the crystal ball, ladies and gentlemen. Like, nobody does, right? You're dealing with government and politics here. If I was a betting man, maybe another increase come the new year, maybe another 2 potentially. But at some point, I feel like we're either going to have to stay stagnant or start to retract.
Okay, so here's the thing. Like when you say you don't have a crystal ball and whatever, you always hear mortgage brokers kind of saying, well, I think this is going to happen. What is that based on? Is that like, do you guys have kind of information that the general public don't have or what?
Yeah, we're always in tune with the lenders. We're always having Zoom calls or emails or staying in the know with these people, right? We're dealing with these banks each and every day, lenders each and every day. What are you guys hearing? Where is the market? Like, what are you guys saying in your meetings, right? Following the economists, following just the big figures in the space. And it's, for me, I think, yes, it was necessary. The rate increases 100%. We were at those artificially low rates, which obviously caused this to where we're at today. But at some point, we're going to have to be hitting a wall because it's damaging our economy. It's damaging people. It's making things a lot more difficult for people, right? So at some point, I feel like maybe in the new year, 2023 could be could be end of 2023, we'll start to maybe see rates start to come down. But as of right now, yes, don't panic, ladies and gentlemen. It could be just a blip on the radar, you know what I mean? Necessary process that we're going through right now. But I feel like things might change for the better in the future. Good thing too is property values are coming down, right? So it's all about perspective on how you look at things, right?
Yeah, so things have changed quickly. So it's kind of hard to kind of predict or understand the impacts that it's had because you still have people that have been locked into their fixed mortgages, so they haven't been impacted. But what have you seen? What kind of impacts so far have you seen on the market? Are people starting to get in trouble? Are you seeing people default on their payments or where
I wouldn't necessarily say seeing people default. You obviously have a lot of clients calling us each and every day. Like, for example, there are many banks that have static variable rate payments where their payment do not change, right? But once you hit your trigger rates on those static variable rate mortgage payments, now there's no more principal being paid down. So it's strictly all interest. You're essentially renting your own house. And what are the banks doing? They're either stretching out your amortization because now it's all strictly interest-only payments. They're giving you the option to either lock into a fixed rate, increase your payment, and do a lump sum payment to get your numbers back in line to an amortization. So what a lot of clients are looking at right now is either, which we help a lot of people do, is refinance that property, maybe put that amortization back to 30 years, maybe looking at a short-term fixed rate option right now to have that peace of mind of no fluctuation, getting things back in line. That's what a lot of clients are doing right now.
Okay, so if you reach that trigger rate, are you forced to do something or can you just keep it, like if you're just paying interest only?
So a bank like TD was coming out saying that they will actually allow you to potentially still maintain your interest-only payment. But inevitably, at some point, if you're coming up to your renewal, you're going to be forced to make a decision, whether it's lock into a fixed rate, increase your monthly payment, or do a lump sum payment to get your numbers back in line. But the longer you go in riding out that interest rate, that interest-only payment, you're not paying any more principal. So your amortization is out of whack. You're not maintaining that amortization schedule to pay down your mortgage. That's what we're seeing a lot of clients dealing with right now.
Sure.
Right?
Yeah. I guess it makes sense in certain situations. If you're an investor, you have a rental property and you just want to see what happens in the next year or two, you're anticipating lower rates, then maybe it makes sense to just keep it and not refi and then, increase your payments dramatically and potentially impact your cash flow.
Exactly. Or you're seeing a lot of clients who are coming up for renewal and they've been all nice and cozy with low 1, 2, maybe 3% interest rates, and then they're getting hit with rates in the 5s. Now you're starting to see banks even with a 6 in front of it now. So there's that shock value where the cash flow has completely been depleted and the numbers are just not making sense. Even more of a potential reason to now refinance it, stretch it back to a 30-year amortization, even at today's higher rates. Maybe it's consolidate debt, keep some money in your pocket on a monthly basis, and ride out this storm, like we say, whether it's short-term, 1 year, 2 year, kind of see where the dust settles and reevaluate.
Mm-hmm. Now, what about 40-year amortizations? What do we have on that?
There's talks. There's been talks of many things. As of right now, there are some lenders that will consider a little bit of a longer stretched out amortization. Is it in the works? Potentially. Nothing has come into fruition fruition just yet. But as of right now, predominantly, the major lenders are still maxing you out at a max 30-year amortization.
Yeah, so these are the A lenders. What about credit unions, B lenders?
Yes, B lenders still 30 years. There are some credit unions that can consider it. We are also seeing if anyone is in the commercial space, there is the potential in the commercial space to do extended amortizations. So yeah, who knows what the government of Canada and these policies that might come into play to kind of solve kind of what's happening, because I like what you said before. I don't think we've really seen the true impact of what's happening just yet. It might take a little bit longer, especially with trying to combat this inflation. It's not like you're going to see results instantly. It's going to take time. We might start to see where things play out maybe next year. But yeah, great point.
When we talk about 40-year AMs, I know I'm kind of catching you like on the spot here. I could have probably given you a heads up before, but can you think of any credit unions off the top of your head that might offer that?
Off the top of my head, no. But obviously, I can look into it for sure. You can reach out to me and get you some details, or any clients or anybody listening, of course.
Sounds good. A couple months ago, appraisals were a big thing. Properties weren't being appraised when people were purchasing them, waiting 2-3 months to close. And then by that point, property values came down. Are you still seeing issues like that, or have you guys resolved that problem?
Yes, that was kind of a big issue at a good chunk earlier on in the year with the property values kind of going down. You were seeing that a lot. But as of right now, you're starting to see the finance conditions come back into place on properties, inspection conditions. When the market was absolutely crazy, you were seeing a hell of a lot more firm offers. But now, not as much. Hey, at the end of the day, if you're doing your due diligence, working with a trusted real estate professional and your realtor or your coach, whomever it be, you're not seeing as much right now. The values are there. It's just tougher because where we're seeing people get impacted the most is people that are wanting to refinance, or people that have done burst strategy methods or conversions where maybe the comparables aren't there anymore and the values aren't there of what they're hoping for. So that's what we're seeing a lot of, hoping for $1 million valuation, but the comparables are at 8 and 850. So what we kind of tell clients is, run your numbers. Does it make sense, or does it actually make sense to hold out and let's see where things happen into the new year, and you might get that appreciation and that value back as well? Because as of right now, an appraisal is based on what? Based on comparables in the areas. So if you're looking to access the most amount of equity out of property, but the comparables with recent sales aren't there, you're not going to get top dollar, right?
Now, another major thing that was happening before is that when the market was on fire, people were over leveraging, taking privates, and then banking on the property being worth so much more once the renovations were complete and that kind of thing. What are you seeing? Like, have you come across situations where people got privates, did the renos, and they're trying to refi and exit out, but the values just aren't there anymore?
100%. We're seeing it each and every day, all the time. But that's where you got to be working with maybe a trusted mortgage professional to look at other options. Maybe it's a Band-Aid fix where we may have to expose and get some equity out of your existing properties to bridge that gap of that shortfall. We're starting to see a lot of private lenders not willing to renew clients just because of the values of what they were securing a private in 2021 and early 2022. Now you're coming up for renewal and that property is not worth what it was when you originally got the loan. Yeah. So you're starting to see that more and more.
Yeah, well, I think last year private firsts at 60% loan to value or 70% loan to value were at like 5%.
Absolutely.
Yeah, which is a crazy amount. But now what are we looking at for privates, if you can just kind of share a little bit?
At the end of the day, it's all based on property, area, and location, loan to value. Private lender is very fixated on the property, area, condition, value, and all of that. That's how they're pricing it. You can still maybe see privates still in the 8s, 9s, 10s, of course. But you have to think about it. Now that you're starting to see the A lenders move from the 5s potentially now into the 6s, now the B lender interest rates are typically anywhere from 1 to 1.5% higher than the A lenders. Mm-hmm. Well, if the B lenders are at that, the private lenders got to now price accordingly on top of that, right? Yeah. So,
but the privates are generally interest only. So sometimes, I guess a private at 8%, the payment might be lower than a B lender.
Correct. Right? Interest only. Absolutely. The fees, you also have to remember when you're dealing with the private lenders, on average, you're looking at maybe 3 to 4% in fees based on the loan amount. So you have to factor that into your calculations as well.
Yeah. So I guess there's a broker fee and a lender fee, but from what I remember, it used to be lower. Like have the fees come up on privates?
They have. It all depends, right? Like this is what I mean, based on the client, based on the property and all of that. Obviously, they're lending on a risk. The better the loan to value, the more skin a client has in the game, that's where you see the more attractive rates and the more attractive fees. But if you're trying to leverage to, let's say, 80, 75% loan to value, it's more risk, especially in this market with values dropping. That's where you see the private lenders pricing higher rates, higher fees, right?
I guess it would be a little bit safer if you're getting a second kind of on your primary residence versus a rental property, right?
Yes, to a certain extent, I agree with you. But when you go into a second position mortgage, maybe rates can tend to be even a little bit higher in the fees because now you're in a second position. You're in a more riskier position for a private lender. But at the same time, not to sound counterproductive to what I'm saying, is sometimes getting a second on a property that has such a good loan to value, you may have very minimal mortgage left on a property or be completely mortgaged or have very little debt on there. It's a very low risk second mortgage to a private lender and you can still get attractive rates.
Yeah. What would be some strategies that you would share now if you're looking to lower your monthly payments, or let's say you have a rental property, your cash flow is a little bit tight on there. What would you recommend doing to address that issue?
At the end of the day, it all comes down to the very basics of running your numbers. What's coming in from an income standpoint? What are your personal expenses? What are the expenses on the property and running your numbers? Going back to what we talked about a few minutes ago, whereas getting people over this hump of this little bit of a bumpy roller coaster ride we're on right now, very, very important that people run their numbers, because by looking at a simple possible refinance on a property, on your rental property, moving things back, stretching out the amortization, getting rid of maybe some personal debt, car loans, lines of credit, credit card debt, shifting it onto your rental, even at today's higher rates, can still be saving you monthly costs each and every month. That's a huge, huge component for a lot of clients that people don't realize is doing that can actually help getting rid of car loans, getting rid of lines of credit, leveraging it onto your rental, pushing it to a 30-year amortization, because you're lowering your monthly obligations, right? So that's number one. Number two, when you actually run your numbers stretching out that amortization, in most cases, that monthly payment tends to be a lot lower if you're factoring in what your current mortgage payment is, factoring in your personal debt that you have and your monthly obligation. So it can actually work for you in favor. It's all about running your numbers, whether it's reaching out to me or your mortgage professional. It's running those numbers and building out a game plan, because everyone likes to say, why would I leverage? Why would I do this? Why would I pay off debt? Well, you're getting rid of your monthly costs. Leverage it onto a rental. People tend to forget that your interest on an investment property also is a tax deduction at the end of the year. So shift that debt there and reevaluate. Let's see where a year or two comes, see where rates are at, and reevaluate.
In case anyone's listening and they don't really understand what you mean by stretching out your amortization, I guess if you've owned a property for, say, 10, 15 years and you've got 10 years left on your mortgage, what you can do is re-amortize, stretch that payment out over 30 years again so that your payment comes down. Even though the rate's a little bit higher, it'll probably be beneficial for you. Exactly. But that process involves qualifying once again for that mortgage, right?
Absolutely.
Yeah. I guess another strategy would be to get a larger home equity line of credit. So splitting your mortgage, instead of being like 100% mortgage, maybe going 50% mortgage, 50% HELOC, home equity line of credit, so that you're paying interest only on the home equity line of credit, which again can reduce your payment. In that scenario, that doesn't work for everyone, because again, you're not paying down your principal when you do that as much, but it could be beneficial for some people.
Exactly. Absolutely can be beneficial. There's always pros and cons to every scenario, but yes, you hit the nail right on the head. By doing that method on the home equity line of credit component, interest only payments, if you wish, you obviously have the ability to pay down more, but there is no principal and interest payment where it's gradually being paid down every week, every 2 weeks, every month. So it may not work for everybody, but it is an option. And that's why reaching out, running your numbers, going through all of the options and see what fits best for you and your family on your property.
And now if you do have a HELOC, from my understanding, with most lenders, you can convert that into a mortgage without qualifying, right?
Correct. At any time. So we use the term in our industry, crystallizing it, meaning at any point you can convert your existing home equity line of credit balance into a mortgage.
Right. And what would be the benefits of doing that? I guess just to include principal pay down as part of the mortgage, or would there be something else?
And as we see as well, like every client is different. Every situation is different. That's what people have to remember, is that there isn't one all end all be all option for every single person in this country. It has to make sense. But yes, converting that home equity line of credit to a mortgage can be beneficial. Principal and interest pay down. maybe you're securing a lower rate compared to where HELOC rates are now at prime plus. Typically most lenders are offering prime plus a half. Some banks are prime plus 1, prime plus a quarter. You're getting up there in an interest rate. But in the same breath, keeping that home equity line of credit balance can still be a lower monthly cost with an interest-only payment to bridge that gap.
Sure. So I'm just going to throw out a scenario here at you. Let's do a case study quickly. Sure. Let's say you got a mortgage last year when the rates were really low, and it's a static variable, and you got it at prime minus 1%, let's say. And then you also have a HELOC as part of this scenario. Let's say you've got I don't know, just for the sake of simplicity, you have a $500,000 mortgage. You've got a $250,000 HELOC. If you wanted to convert that HELOC now into a mortgage, what would happen? Would it blend into the existing mortgage because you've got a prime minus 1%, or what would happen in that scenario?
Great question. You would actually be converting that home equity line of credit into a second mortgage, not second mortgage like a private lender type second mortgage, but a second component mortgage based on today's rates. It would be beautiful if we'd be able to leverage it and kind of amalgamate it with the existing rate, but it would be based off today's rates, not what you originally secured your first mortgage portion.
Got it. So your first mortgage would stay exactly
Correct.
as it is. You're paying prime minus 1% on that, but like you said, it's a second mortgage that the HELOC component would turn into a second mortgage, and you would pay whatever the rate is today.
Correct.
On a 5-year fixed, I guess, or a variable?
You could look into any option of what you wish, whether it's 1 year, 2 year, 3 or 4 year, 5-year fixed, variable. In my opinion, I know you haven't asked the question, but I do kind of like for most clients right now not to be thinking long-term strategy of securing and locking into rates, especially where hitting or at the peak of where interest rates have been for many, many years. I kind of like the short-term Band-Aid strategy of maybe looking at a 1 year or a 2 year option. Why? Because if we do believe things might start to change in 2023, even 2024, you don't want to be committed to a high rate locked in for so long. You want to be in something short-term Band-Aid fix. Why? Because if things do change in our favor, we want to have the ability to pounce if rates do come lower, and we don't want to be locked in for a long duration of time.
Makes sense. If I go back to that case study once again, let's say you have some equity in that property. Let's say it's worth $1 million now, and would it be possible to top up that HELOC before converting it into a mortgage?
Sure, of course.
Just to maintain that first, because you have prime minus 1, so you might as well keep that.
Sure, of course. Hey, at the end of the day, it's all about qualification. If your numbers work and you can qualify, so in Canada, based on numbers, based on your income and your debt service ratios, is up to 80% of the appraised value, 80% of the value of the home. If your numbers work, of course, you can look to restructure things. Maybe there's added equity that you qualify for, have an increased line of credit, convert things to a mortgage. Sometimes it might make sense to amalgamate everything into one clean mortgage setup and have another line of credit. It's just all about numbers and structure.
Yeah. Maybe if we dive into some of the lenders, are there any maybe unique products out there with certain lenders maybe that cater to self-employed people, or just anything that you've come across recently that sounds interesting to you?
Yeah, of course. Most banks, I shouldn't say most banks, there's some banks that have great net worth programs where maybe we don't have the greatest of provable income. There's net worth programs if we are high asset net worth clients. There's programs going based off business financials and looking over a 2-3 year history of the business that banks offer. B lenders are also great options for clients as well. Yes, they do come with a little bit of a higher interest rate. Yes, they typically charge small one-time upfront fees, but this could be night and day of a client qualifying for hardly anything with an A lender bank, because we have to remember, when you qualify with an A lender, it's black and white. When you qualify with a B lender, they use a more realistic approach. They use more 6-12 month bank statements. They use a more stated gross income approach to help you qualify. And this can be the difference of you qualifying for a $200,000 mortgage versus with a B lender qualifying for a $700,000-$800,000 mortgage. So there's different programs out there. Every client is different. And that's what it comes down to, working with a trusted professional, because especially working with a mortgage broker, you tend to have more access to multiple channels. Not to knock any banks, we work with the banks every day, but when a client specifically goes and walks into a branch and deals with a bank, you can only deal with their underwriting, their products, their interest rates. When you need maybe a vast majority of options to get you the best options. And that's what personally myself, my company, we try to strive for, is we don't sell a client on anything. We're here to provide options, build a game plan for you, and the decision is yours which avenue you want to go.
Mm-hmm. Got it. I'm going to put you on the spot again, but you you mentioned a net worth program. Can you name maybe a lender that has that program available?
Scotiabank has one. We work with Scotiabank a lot. RBC has one. I believe TD, but predominantly we work a ton with Scotia on their net worth asset program. They have a really, really good one. We work with a lot of clients on that.
Well, I know there was a point in time where like some of the brokers I was talking to, they kind of stayed away from TD because they became tougher to deal with or whatever. But I think lately they've changed their policies.
Yes.
They become a little more investor friendly. Is that right?
100%. You hit the nail on the head with that one. So TD, love TD. We do a ton of business with TD. Great bank, great rates. They're awesome. But yes, they tend to have the stigma of being a hell of a lot more strict and stringent compared to other lenders. But yes, they've kind of, I don't want to use the term loosened up, but yes, they've become a little bit more investor friendly, which is super, super advantageous for clients and investors to have another path and an avenue. Scotiabank is a very investor-friendly bank that we work a ton with, because you also have to remember, when you're as an investor, it's all about structure and trying to put yourself in the best position to continue to grow and build your portfolio. Don't get me wrong, interest rate is super vital and super important, but as an investor, if you have dreams, goals, and aspirations of growing and building your portfolio, there is kind of a structure of the order of the banks that you want to try to fit in. Why? Certain banks are going to cap you at certain amount of properties before they just cut you off. So it's all about navigating through the bank channels to maximize your portfolio. But to touch on your point, why TD is a little bit more strict and stringent is one predominant reason is a lot of clients do have home equity lines of credits. A lot of clients do have maybe multiple pieces of real estate. They're one of the banks that actually uses the HELOC limit against you. Even if you're not carrying a balance, a home equity line of credit, whether you have a $500,000 HELOC on your home, a bank like TD will use that full limit against you, where maybe a bank like Scotiabank only cares about the balance. Don't get me wrong, TD can be very favorable with clients, so can Scotia, and so can other many lenders, but it's all about trying to fit the box to see what makes the most sense.
Got it. So if you have like the ideal client for TD, what would their kind of finances look like? Just out of curiosity, would they have like very few rental properties and high income, or would it be? Why would somebody go to TD?
Well, I'm going to go a little bit technical in my world right now. It might go over some people's heads that are listening, but like, for example, on your very first investment property pre-approval when you're qualifying, TD's not always the greatest lender because they use offset. They use 50% added to gross of your rental income, where another bank can use potentially 50% of the rental income or 80% offset of the income, where they're using a 50% added to gross. So it's not really favorable on your first rental, but where TD can be super advantageous is moving to now property 2 and so on. In a perfect world, guys, it's tougher to qualify for every single human being in Canada right now, just because the higher the interest rate, the higher the stress test is. If we're now hitting rates at 6%, let's just say, the bank's qualifying you at 8% stress test. So everyone's borrowing capacity has been diminished over the last year.
Have there been any talks about removing the stress test?
Potentially, yes. So when you were asking about the stretched out amortization, there was even talks where they were saying for an investors, they actually wanted to potentially get rid of using home equity lines of credits towards down payment and all of this. But the other one that they were talking about was that, exactly.
Okay. Interesting. Just so many different changes. Do you have an idea of which bank might be favorable towards self-employed people, or might have a good program for people that are self-employed?
Scotiabank's a good bank with those programs. It's possible. I'm not saying it's a slam dunk guarantee. Obviously, you always have the B lenders in your back pocket, and you also have to remember, too, with the B lenders. The beautiful thing about B lenders is they use a more realistic approach to qualify you when you are self-employed, using like more gross income approach. You have to remember, you're not there to stay with a B lender like a home trust, like an Equitable Bank. People have probably heard of them. They're some of the biggest lenders in the space. If we can get you in a position to qualify, maybe it's securing that property, staying with them for a year or two, and then having us qualify with an A lender, or vice versa, right? Maybe it's co-signers. Maybe it's looking at options to get our numbers back in line to qualify with an A lender. Mm-hmm. It's all about numbers, because my conversation can go down 2 different paths. If we're looking at a primary residence property that we are paying for, very rate driven, very focused of that structure. It's something that's costing you and your money to live in. But when we're talking investment, we have to look at the bigger picture and the strategy. There is no emotional attachment when you're buying investment real estate. It's just all about numbers and making sense. It's got to make sense for you.
Yeah. Okay, cool. I appreciate you sharing all that.
Maybe great questions, buddy.
On the spot, I told you. Last thing is buying in HoldCOs. So let's talk a little bit. I know in the past, brokers weren't able to qualify for properties under HoldCos through Scotiabank, but that's recently changed.
Yes.
Do you have access to other A lenders or whatnot that are able to finance?
Yes. So Scotiabank recently, I would say within probably the last year and a bit, they have actually changed their ways through the mortgage broker channel. They are allowing purchases under a corporation, which has actually been absolutely fantastic. You have to remember too, inside the mortgage broker channel, we have access to many, many lenders, but out of the major lenders, your specific is Scotia and TD. Every single mortgage broker, their access in the mortgage broker channel is Scotia and TD. This doesn't mean that we don't have relationships and contacts and people that we can point you to at other lenders and all of that. But to go back to your question, yes, that has been a huge life-changing thing in the A-lender space for the broker channel with the corp. Now, one thing I always like to set the precedent on any client phone call, any Zoom meeting, any meeting that I'm having with a client is when you are qualifying for a mortgage under a corporation, it makes no difference to me, your mortgage broker, or to the mortgage agent if you're buying under a corp or personally. The qualification is still identical. It's still you personally guaranteeing the mortgage. The real only difference buying under a corp for personally is pretty much most lenders, 95% of all lenders, the rate tends to be maybe a touch higher when you buy under a corporation versus personally. That shouldn't be the make or break reason why you don't buy under a corp. Always got to speak with your lawyer, speak with your accountant, speak from that standpoint of the pros and cons and do your due diligence on deciding buying under a corp or not. And the other big thing is not having access to a home equity line of credit if the property is under a corporation. That could be a make or break factor for a lot of clients.
You're talking about with Scotiabank though.
Correct.
Yeah. Okay. Yeah. That's interesting because I do have some properties under corps, but they're not with Scotia, and I do have a HELOC on them. So I guess it depends on
which lenders are they with?
RBC.
RBC, there you go. I was just about to say. That's why I said 95% of the major lenders won't allow you to have it. RBC is one of them that will consider having a home equity line of credit under a corporation.
Okay, cool. I wasn't even aware of that for Scotiabank. Okay, good to know. Before we move on, any final words, anything you want to share?
No, man, I just thank you for having me here today. I told you I was checking out some of your content over the last couple of days. You've had some pretty common people that we know mutually together. But yeah, if anyone needs anything, has any questions, please feel free to reach out to me or my team. You can reach out to our office. You can call us. You can reach out, find us on Instagram at bm.select, or you can reach out to me at Michael Zanzini MTG. Call our office, 905-569-8326. Happy to help if anyone has any questions, anything mortgage related, residential, commercial, private lending, refinance, purchase. We're here to help.
Sounds good. Thank you so much for coming by. Appreciate you doing this.
Thank you, buddy.
And yeah, we'll be in touch.
That was awesome, man.
Thanks for listening to this episode. Your support is truly appreciated. And if you can share this with a friend or family member that might benefit from the information, remember our goal is to motivate and inspire others to take action and to build wealth and to become well off. Enjoy the rest of your day.